What's happening, crypto fam? Get ready, because the news cycle is absolutely on fire today, and we've got the critical updates you need to stay ahead. This is Bitcoin Bulletin, and we're diving headfirst into a story that's sending shockwaves through the legal system, proving that justice, even with digital assets involved, is always on the move. Plus, we're tracking the big players making strategic moves in the stablecoin space, all while keeping a laser focus on Bitcoin's price action as it dances with some seriously crucial support levels. You do not want to miss this. Let's get into it. First up, we've got a real-world drama unfolding with a major judicial warning in India. Think high-stakes crime, massive amounts of cryptocurrency, and a sentence that's making headlines. This is a deep dive into how digital assets are intertwined with serious legal consequences, and it's a must-watch. Then, we pivot to the sophisticated world of institutional investors. Are they the silent drivers of the next big market surge, or is retail hype still the name of the game? We're breaking down who's really moving the needle in the potential 2025 rally. Get ready for some eye-opening insights. Next, a major stablecoin issuer is making waves with a significant shift in strategy. They're reevaluating their presence on smaller networks, opting to double down on the big leagues. We'll explore what this means for liquidity, scalability, and the overall DeFi landscape. It's a move that could reshape how we interact with stablecoins. And finally, we're zeroing in on Bitcoin's price chart. Is it heading for a breakout or a breakdown? We're analyzing the critical support levels that could determine the market's next major move. This is the technical breakdown you've been waiting for. Stick around because you need to know this. Don't forget to smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. Justice served, a digital heist's fallout. In a stunning turn of events that highlights the complex intersection of cryptocurrency and the law, an Indian court has delivered a landmark verdict, sentencing 14 individuals to life imprisonment. Among the convicted are a former member of the Legislative Assembly from the Bharatiya Janata Party and 11 police officials, marking a significant moment in the nation's fight against corruption and organized crime. This high-profile case, stemming from a 2018 incident, involved the brazen kidnapping of a businessman with the intent to extort a substantial amount of Bitcoin and cash. The court's decision sends a clear and unequivocal message about the severe consequences of abusing public office and engaging in criminal activities, particularly those facilitated by digital assets. The details emerging from the trial paint a picture of a sophisticated operation. The businessman, identified as Shailesh Bhatt, a resident of Surat, had reportedly recovered 752 Bitcoin from an associate connected to a defunct cryptocurrency venture. Upon learning of this significant digital asset holding, the former MLA, Nalin Katadia, allegedly conspired with senior police officers from Amreli district, including the then Superintendent of Police Jagdish Patel, to abduct Bhatt. The motive was clear: to seize a portion of the recovered Bitcoin and extort further funds through coercion and illegal detention. Bhatt was reportedly held captive near Gandhinagar, subjected to physical assault, and pressured to confess to transferring cryptocurrency to associates and selling it for cash. The perpetrators demanded a hefty ransom of 176 Bitcoin and Rs 32 crore, further complicating the situation by forcing the sale of 34 Bitcoin from an associate's wallet, netting an additional Rs 1.32 crore. The legal proceedings were extensive, with the trial involving testimony from 173 witnesses. However, the integrity of the judicial process faced a significant challenge when a substantial number of witnesses, specifically 25, were found to have committed perjury, providing false evidence to mislead the court. In a decisive move to uphold justice and deter future misconduct, the court not only handed down the life sentences, but also penalized these witnesses for their perjury. Furthermore, the court ordered the confiscation of gold ornaments recovered from the Amreli SB, directing their transfer to a national mint, adding a layer of financial consequence to the criminal convictions. The court's strong stance on perjury underscores the judiciary's commitment to maintaining the credibility and effectiveness of the legal system. This case is more than just a criminal conviction. It serves as a potent reminder of the evolving landscape of crime in the digital age. As cryptocurrencies become more integrated into the global economy, they also present new avenues for illicit activities. Law enforcement agencies worldwide are grappling with the challenges of tracing digital assets and prosecuting complex financial crimes. The sentencing in India highlights the judicial resolve to tackle such offenses head-on, demonstrating that even in the realm of decentralized digital currencies, accountability and justice will prevail. It's a critical development for anyone involved in the crypto space, signaling the increasing scrutiny and regulatory attention these assets attract. This gripping account of justice in the digital age is just the beginning of our deep dive today. Stay tuned as we uncover how the big players are shaping the future of stablecoins. Institutional whales signaling a new era. The cryptocurrency market, particularly Bitcoin, has long been characterized by its volatility and the often dramatic influence of retail investors. However, recent trends suggest a subtle yet significant shift: the growing impact of institutional players on market movements. As Bitcoin approaches potentially significant rallies, understanding the dynamics between these large-scale investors, often referred to as whales, and the broader retail sentiment is crucial for anyone trying to navigate the market. This dynamic is increasingly seen as a key determinant in the trajectory of Bitcoin's price, especially as we look towards potential major upward movements in the coming years. Historically, the crypto space was dominated by early adopters and individual enthusiasts. The narrative was largely driven by grassroots adoption and speculative fervor. However, the landscape has matured considerably. We've seen increased participation from traditional financial institutions, hedge funds, and large corporations. These entities often operate with different motivations and risk appetites compared to retail traders. Their entry into the market, often through regulated vehicles like Bitcoin ETFs or direct accumulation, can inject significant capital and influence market sentiment in ways that individual retail trades cannot. This institutional adoption is often seen as a validation of Bitcoin's potential as a legitimate asset class, moving it beyond its early speculative roots. The concept of a quiet bull run emerges from this observation. While retail hype can create explosive, short-term price pumps, institutional accumulation often happens more methodically and over longer periods. These large players might be accumulating assets during periods of lower volatility or even price dips, positioning themselves for future growth without necessarily generating the same level of public fanfare. This can lead to a scenario where the market is experiencing significant underlying buying pressure from institutions, even if the day-to-day price action doesn't reflect a frenzy of retail excitement. The focus for these investors is often on long-term value appreciation and the strategic allocation of capital within a diversified portfolio. Analyzing the behavior of these institutional whales involves tracking on-chain data, such as large wallet movements, and monitoring the inflows and outflows from institutional-grade investment products. When large quantities of Bitcoin are moved from exchanges to cold storage, or when investment vehicles designed for institutional investors see consistent inflows, it can be interpreted as a signal of accumulating demand. This contrasts with retail-driven rallies, which are often characterized by widespread social media buzz and a surge in new retail accounts opening on exchanges. The debate continues on whether the 2025 rally, should it materialize as predicted by some, will be primarily fueled by sustained institutional buying or by a resurgence of retail FOMO, fear of missing out. Ultimately, the interplay between institutional capital and retail sentiment creates a complex market environment. While retail investors can amplify price movements and create significant buzz, the steady, strategic accumulation by institutional players may represent a more sustainable driver of long-term price appreciation. Understanding this dichotomy is key to developing a comprehensive market outlook and making informed investment decisions in the evolving cryptocurrency ecosystem. But what happens when the very foundations of stablecoin circulation begin to shift? We're about to explore a major strategic pivot by a leading stablecoin issuer that could reshape the DeFi landscape. Tether's strategic pivot, focusing on the giants. In a significant move that reflects the evolving dynamics of the stablecoin market and the broader blockchain ecosystem, Tether, the issuer of the world's largest stablecoin, USDT, has announced a revision to its strategy regarding support for various blockchain networks. While initially planning to freeze USDT on several smaller chains, Tether has reversed that decision, allowing USDT to remain transferable. However, the company is simultaneously halting the issuance and redemption of USDT on specific networks, including OmniLayer, Bitcoin Cash SLP, Kusama, EOS, and Algorand. This strategic recalibration signals a clear focus on prioritizing major, high-activity blockchains like Ethereum and Tron, aiming to bolster liquidity and streamline DeFi integrations. The decision to allow continued transferability on these 5 blockchains, while ceasing new issuance and redemption, is a nuanced approach. It acknowledges community feedback and the practicalities of existing USDT holders on these platforms. However, the cessation of official support for minting and redeeming USDT on these chains effectively phases them out as primary hubs for Tether's operations. This move is driven by Tether's overarching strategy to concentrate resources and development efforts on networks that offer greater scalability, robust developer activity, and substantial user demand. Ethereum and Tron have emerged as the dominant platforms for USDT, with billions of dollars in circulation on each, making them the natural focal points for Tether's future development and integration strategies. Data from DeFi Llama vividly illustrates this concentration, showing over $80 billion in USDT circulating on Tron and more than $72 billion on Ethereum. These figures dwarf the activity on many other chains. BNB Chain follows as a distant third with approximately $6.78 billion in USDT. While other networks like Solana and Ethereum's Layer 2 solutions are experiencing growth, their stablecoin activity often favors USD Coin, USDC, over USDT. The impact of Tether's decision on the affected chains varies. OmniLayer, for instance, holds a notable $82.9 million in USDT, making the cessation of support more impactful. In contrast, networks like EOS, Bitcoin Cash SLP, Algorand, and Kusama have significantly smaller USDT balances, often under $1 million each. This disparity underscores Tether's pragmatic approach to resource allocation, focusing on where the majority of its value and utility resides. This strategic shift by Tether is emblematic of a broader trend within the cryptocurrency and decentralized finance, DeFi sectors, consolidation and optimization. As the industry matures, projects and platforms are increasingly focusing on core functionalities and high-impact ecosystems. By concentrating on major blockchain hubs, Tether aims to enhance the efficiency, security, and accessibility of its stablecoin for a larger user base, and for integration into high-growth DeFi applications. Furthermore, Tether is actively exploring innovative deployment methods, such as utilizing the RGB protocol on Bitcoin, to expand its reach and utility across different blockchain environments. This forward-looking approach ensures that Tether remains at the forefront of stablecoin innovation and adoption. The broader stablecoin market continues its robust expansion, with a total market capitalization reaching nearly $286 billion. USDT and USDC remain the dominant players, commanding significant market share. Recent regulatory developments, including the signing of the Genius Act in the United States, are poised to further solidify the role of stablecoins in the global financial system, reinforcing the dominance of the US dollar. Tether's strategic decisions are therefore made within a context of increasing regulatory oversight and market maturity, emphasizing the need for operational efficiency and strategic focus. As Tether reconfigures its network strategy, another critical battle is brewing on the price charts. We're diving into Bitcoin's battle for survival at a key support level that could dictate the market's next major move. Bitcoin's critical juncture, the $112K support test. Bitcoin's price action is currently at a pivotal moment, testing a crucial ascending trendline that has supported its rally for the past 2 years. After reaching recent highs, the cryptocurrency experienced a significant pullback, briefly dipping to $110,000. This downward movement triggered substantial liquidations across the broader crypto market, with over $411 million in positions being forcibly closed, predominantly long positions. This event has heightened market volatility and raised critical questions about Bitcoin's ability to sustain its bullish momentum or if it's poised for a more substantial correction. All eyes are on the $112,000 mark, a level that analysts believe is key to maintaining the current upward trajectory. The market is abuzz with speculation regarding Bitcoin's next move. Analysts are closely monitoring the $112,000 support level, with many warning that a decisive break below this threshold could signal a further decline, potentially towards $105,000 or even $100,000, as suggested by some market watchers. The fragile nature of the current market sentiment means that any sustained breach of this support could trigger cascading sell-offs. This technical outlook is compounded by broader market conditions, where investor sentiment remains mixed. While some see Bitcoin as a long-term store of value, a digital gold hedge against inflation, others remain skeptical due to the asset's inherent volatility and the perceived lack of traditional financial fundamentals to underpin its valuation. This ongoing debate fuels the speculative nature of Bitcoin trading. The ripple effect of Bitcoin's price action is evident across the altcoin market. Major cryptocurrencies such as Ethereum, XRP, and Dogecoin have also suffered sharp losses in correlation with Bitcoin's decline. Ethereum, for instance, has fallen below its 20-day exponential moving average, EMA, a technical indicator often used to gauge short-term trends. XRP has broken key resistance levels, indicating potential weakness, while Dogecoin faces the risk of a significant price drop if bullish momentum fails to reassert itself. These correlated movements underscore the interconnectedness of the crypto market and its sensitivity to Bitcoin's performance and broader macroeconomic factors. Despite the current volatility, the long-term outlook for Bitcoin remains a subject of intense discussion. The cryptocurrency has seen remarkable gains over the past year, pushing past the $100,000 mark and capturing the attention of both retail and institutional investors. Factors such as increasing regulatory clarity and growing adoption by corporations are cited as positive developments that bolster crypto's appeal. However, the market's speculative nature means that rapid gains can be followed by equally rapid reversals. Traders are advised to exercise caution, recognizing the potential for both significant upside and downside risks. The coming weeks are critical in determining whether Bitcoin can consolidate its gains and push higher, or if it will succumb to selling pressure and retrace further. This period of price discovery and consolidation is a crucial test for Bitcoin's resilience and its established support levels. The outcome of this test will likely set the tone for the broader cryptocurrency market in the near future, influencing investment strategies and market sentiment alike. And that wraps up our deep dive into today's top stories. We've covered a lot of ground, from legal dramas to market strategies and critical price points. Stick around for a quick recap and our full call to action. All right, crypto crew, that's a wrap on another action-packed Bitcoin bulletin. We saw a major judicial warning in India with life sentences in a Bitcoin extortion case, uncovered the quiet influence of institutional whales in Bitcoin's potential 2025 rally, learned about Tether's strategic shift to focus on major blockchains, and analyzed Bitcoin's critical battle to hold the $112K support level. Don't forget to hit that like button if you found this valuable, subscribe for all your essential crypto updates, and ring that notification bell so you're always in the loop. Follow us on all our social channels for more real-time insights. We'll catch you on the next one.